When you see gold prices evaporate by 2% in a single night, and you're frantically hitting the sell button out of pure fear, on the other side of the ocean, the financial giants are smiling. While the crowd is panicking, central banks are quietly executing a historic liquidity grab. Is this a genuine collapse, or just a spectacular trap designed by smart money to flush out the weak hands? In the last 24 hours, the headlines have been relentless. Gold and silver haven't just dipped, they've plunged. The mainstream media is quick to point the finger. A renewed risk-on sentiment, a surging US dollar, and shifting energy markets are supposedly killing the demand for safe havens. On the surface, the logic seems airtight. Why hold a non-yielding metal when the stock market is green and bond yields are skyrocketing? But here is where things get interesting and where most retail investors lose their way. If you only look at the red candles on your trading screen, you're missing the real story happening behind the curtain. We're witnessing a massive contradiction. On one hand, the Western paper gold market is seeing a wave of liquidations. On the other, the physical gold demand in the East is reaching a fever pitch. This isn't just a price fluctuation, it's a strategic migration of wealth. In this deep dive, we're going deep. We aren't just going to talk about why prices fell, we're going to expose who is actually buying this dip while you're being told to run for the hills. We'll analyze the secret reports from the World Gold Council and the quiet maneuvers of the BRICS Plus nations that the nightly news won't tell you about. By the end of this deep dive, you'll understand exactly how the smart money uses 2% drops to consolidate power, and more importantly, you'll see where the floor of this market truly lies. Buckle up, because the charts are lying to you, and the truth is far more lucrative. To understand why you feel that sudden urge to sell your gold right now, we have to look at the Wall Street dashboard from yesterday. It was a sea of green for stocks, but a bloodbath for precious metals. This is the classic risk-on trap in full effect. Think about it. When the S&P 500 is hitting new highs and tech stocks are surging, gold suddenly looks like dead money. It doesn't pay a dividend, it doesn't have a CEO, and in a high-speed digital market, it feels heavy, outdated. This psychological shift is exactly what the big players count on. According to recent data from Reuters, two massive gold killers have returned to the stage: a surging US dollar index and skyrocketing 10-year Treasury yields. In the world of traditional finance, these are the two pillars of the gold-down logic. When the dollar is strong, gold, which is priced in dollars, becomes more expensive for the rest of the world, naturally suppressing demand. But the real gut punch for retail investors is the opportunity cost. If you can park your cash in a US government bond and guarantee a 4 or 5% return, why would you sit on a bar of gold that just sat there and lost 2% of its value in a single session? This logic is precisely why we're seeing a massive exodus from gold ETFs. Retail investors are fleeing. They are looking at their screens, seeing the red candles, and listening to the mainstream analysts tell them that the inflation hedge is broken. They are clicking sell because the short-term pain of losing 2% feels more real than the long-term protection of a hard asset. But wait, before you join that line at the exit, ask yourself one question. If the paper market is so convinced that gold is dead, why is the physical metal still disappearing from vaults at record speeds? You see, the Wall Street dashboard shows you the price, but it doesn't show you the destination of the gold being sold. The logic of USD up equals gold down is a 20th century rulebook that is being shredded in real time by players who aren't looking at next week's trade, but at the next decade's survival. To see the real picture, we have to stop looking at the New York ticker and start looking at the quiet, massive migration of physical bars heading east. Because while you are being distracted by the risk-on hype, A much deeper, much more calculated game is being played in the shadows of the global reserve system. Let's pull back the curtain on the silent migration and see who is actually catching the gold you're dropping. But be careful, because the digital ticker can lie to you. While Western ETF screens are bleeding red, vaults in Shanghai and Dubai are witnessing massive, unseen inflows. We are currently living through one of the greatest geographical shifts in financial history, what experts call the Great Migration of gold from west to east. To understand this, we have to look at the data from the World Gold Council that doesn't make it to the mainstream morning news. There is a glaring decoupling happening right now. In London and New York, institutional investors are selling paper gold. These are digital contracts and certificates. They see a 2% drop and they panic sell to protect their quarterly bonuses. But look at the physical market. While the paper price drops, the physical demand in nations like China, India, and across the BRICS Plus bloc is hitting record highs. For these players, a 2% price drop isn't a signal to flee. It's a Black Friday discount on the most important asset in their strategic reserves. Why is this happening? It's all about a term you've likely heard more and more lately: de-dollarization. For decades, the US dollar was the undisputed king, and gold was just a side character. But since the freezing of Russian foreign reserves in 2022, the world's central banks have had an epiphany. If your wealth is held in another country's currency or within their banking system, it isn't really yours. It can be turned off with the flip of a switch. This is why we are seeing central banks, led by the People's Bank of China, buying gold at a pace we haven't seen in half a century. They aren't buying digital certificates on a screen. They are taking delivery of physical 400-ounce bars and flying them to secure vaults in Beijing and Moscow. The East is preparing for a world where the dollar is no longer the only game in town. They are building a gold-backed insurance policy against the debt-laden Western financial system. Think about the irony here. Western retail investors are selling their gold to buy US tech stocks at all-time highs, while the world's most sophisticated sovereign buyers are selling their dollars to buy the very gold the West is discarding. In financial circles, this is known as transferring wealth from weak hands to strong hands. The Western public is being fed a narrative of risk-on stability, while the global power players are quietly fortifying their basements with hard assets. But this leads us to an even deeper question. If the central banks are buying the dips so aggressively, why is the price still allowed to fall? Is this just a market coincidence, or is there a more calculated game being played by the smart money to keep prices suppressed while they finish their shopping? To find that answer, we have to look at the mechanics of the liquidity grab and how the big banks are using your fear as their greatest tool for profit. So, we've seen the retail panic and the silent migration to the east, but this leads us to the ultimate question. How do the sharks, the big banks, and institutional hedge funds actually profit from this? To understand their game, you have to stop thinking about price and start thinking about liquidity. You see, a 2% drop in gold isn't an accident. In the world of professional trading, this is often a calculated liquidity grab. Think about where most retail traders put their safety nets. When you buy gold, you likely place a stop-loss order just below a recent support level. Thousands of small investors do the exact same thing. This creates a massive pool of sell orders sitting right under the current price. Smart money knows exactly where those orders are. By pushing the price down just enough, that 2% plunge we just witnessed, they trigger all those stop losses at once. Suddenly, a wave of forced selling hits the market. To you, it looks like a crash. To a billion-dollar fund, it looks like an opportunity. They need that massive wave of selling so they can buy thousands of ounces of gold without driving the price up against themselves. They are using your fear to fill their pockets at a discount. This is the sharks hunting in the shallows. But there's a deeper layer to this Van Buy, this gamble. The big players aren't just looking for a cheap entry, they are managing a transition. We are currently seeing a historical wealth effect shift. While the mainstream media keeps your eyes glued to the volatility of the 24-hour chart, the smart money is focused on the wealth effect of inflation. They know that despite the short-term strength of the dollar, the long-term debt levels of Western nations are unsustainable. They need you to believe gold is a relic of the past, so you'll keep your capital in the banking system, a system they control. If everyone rushed for the exit at the same time, the system would break. So they use these sharp 2% corrections to reset the market sentiment. It's a psychological reset button. It flushes out the speculators and ensures that only the most disciplined hands hold the real assets. Think about the lock-in effect we've seen in the housing market, where high rates have frozen inventory. A similar thing is happening here. By keeping the gold price volatile and occasionally scary, they prevent the general public from locking their wealth into a safe haven that the banks can't easily manipulate or tax. They want you playing their game, buying high PE tech stocks or chasing the latest crypto trend, while they quietly diversify into the one asset that has outlived every empire in history. So, as we look at the wreckage of this recent price drop, we have to ask ourselves, are we going to keep being the liquidity that the big banks feast on? Or are we going to start recognizing the patterns they use to manipulate our emotions? The evidence is clear. The price on your screen is a distraction. The real movement is happening in the vaults, in the central banks, and in the strategic maneuvers of the smart money. But where does this leave us for the months ahead? Is the bottom finally in, or is there one more trap waiting for us? Let's wrap this up by looking at the only trend that actually matters for your portfolio. At the end of the day, a 2% drop in gold isn't the end of the story. It's just a new chapter in the redistribution of global wealth. What we've seen today isn't a failure of the asset, it's a transfer of power. Gold is moving from weak hands, those driven by short-term fear, into strong hands, the institutional giants and central banks who think in decades, not days. While the mainstream narrative tries to convince you that the safe haven era is over, the macro reality tells a much more dangerous story. Global debt is hitting record levels, geopolitical tensions are a ticking bomb, and the petrodollar system is facing its greatest challenge in history. In a world like that, gold isn't just a commodity, it's the ultimate insurance policy. The smart money knows that real wealth isn't made by following the herd into the latest hype. It's made by staying disciplined when everyone else is panicking. They want you focused on the red candles on your screen so you don't notice the massive accumulation happening in the vaults. So, I leave you with one final question to consider. When the dust settles and the true value of the dollar is tested, whose side of the trade do you want to be on? Will you choose to stand with the crowd that's running for the exit, or will you stay quiet and observe the calculated moves of the central banks? What is the floor price where you believe the sharks will finally stop their feeding frenzy and the real rally begins? Let me know your thoughts in the comments below. I read every single one. If this deep dive helped you see through the market noise, don't forget to hit the like button and subscribe to stay ahead of the game. Thanks for watching, and I'll see you in the next analysis.